All right. Good evening, everyone, and thank you to everyone who's here joining us today. My name is Lisa Partida with Home Again LA, and today is our second session of the month for the First-Time Homebuyer series presented by Operation Hope. So today we have our special guests, Isabel Duran, who's going to be handling the slides, and Rosa Amaya. And I'll go ahead and pass it along for them to introduce themselves.
Okay, you ready?
Yes, ma'am. All right,
Okay.
everyone. Good evening. Thank you for joining us today. We have Miss Isabel on the IT section today. She'll be managing this the presentation, but she has great information, great experience in the homeownership credit counseling world. Just a little bit about myself, very briefly. I come from Operation Hope myself as well. I worked there for 15 years before I joined the banking side. They say the dark side, but not so bad. Not such a bad dark side. I have been with different banks for the past 10, 11 years, currently working with New American Funding, a great financing institution that works with different down payment assistance program. And one thing that I love to do is participate and share the knowledge that I have acquired through the process of working with different banks and the different programs are available. Show that in Isabel gives us just the opportunity to be able to work with you guys and provide that information. So topics that we're going to cover today. What is a mortgage loan? We're going to talk about how do you get a mortgage loan, talk about the steps involved in obtaining that loan, what's requirement from the lender, what is required for the loan approval, and the difference between the pre-approval and a pre-qualification. How much is a lender willing to lend based on the guidelines that the banks and the financing institution has? How do you know if you're ready to buy a home, which is one question that a lot of people ask, well, when is the right time to buy a house? When do I take that step? So we'll talk about that. Calculating qualifications, we're going to talk about those numbers as well. How do we calculate the qualification portion? How do you increase your borrowing power? Once you see the numbers, sometimes you're like, that's not enough. I need to increase my purchase power. And definitely that's one thing that we can do is guide you on things that you can accomplish in order to increase that borrowing power that you need. Next. So this is the process. We go from research, which means you as the consumer, you're looking for the different type of loan programs are available. So a great step is being here today and taking the home buyer workshop so that you can find out what programs are available, what's out there, what's required in order for me to take the next step of submitting a pre-approval for application for pre-approval. So there are multiple steps, there are multiple individuals in the whole process of buying a house. So talking to your bank, talking to Isabel, who has access to multiple lenders, she could give you guidance on this bank offers this product. Rosa offers this product and the multiple layerings that we're able to do through the programs that we offer. Loan application, we'll talk about what's required through the loan application process. What are you going to be submitting? There's a difference between your pre-approval and your loan application. So your pre-approval is presenting your first documents to let the loan officer know this is my income, these are my taxes, these are my savings, this is my savings towards the money that I have saved for the purchase of the home, because you need to have at least some funds. Most banks require for you to have some skin in the game in order to be able to obtain a home. So pre-approval process is the very beginning of it. I want to know how much I qualify for. Can you run some numbers for me? Can you run the credit report? And we'll talk about the difference between a pre-approval and a pre-qualification. Once you have received that pre-approval letter, you're going to move into working with a realtor and finding a property. with that pre-approval letter, it's going to show how much you qualify, how much is for a purchase of a home. So the purchase amount, the loan amount, what assistance programs you have available that we're going to be able to layer on top of your loan. And also if there's grants, what's the interest rate? That letter is going to show your credit scores. And also if you have to come in with money towards the transaction. That is your pre-approval letter for you to go and present offers. Once your offer is accepted, then you're going to come back and we're going to look at your full loan application. Now we have to show the property address. We have to show and request the appraisal on the property. So now we're completing more items. Maybe you might have provided me only with 2 pay stubs, 1 bank statement, and 1 year tax returns for the pre-approval. For the loan application, we need everything. We need W-2s, pay stubs, tax returns, 2 to 3 pay stubs, or 1 to 2 months of pay stubs to confirm the income. If we're gonna use overtime, bonuses, commissions, we need to verify that information as well. So this is where it takes place during your loan application process. There's more questions that we're gonna go over with you on the loan application to make sure that we are letting the underwriting know that we have covered all the bases. Once we have your application, we're going to complete application of the documents have been collected. We're going to send your file to the loan processor. That's a second set of eyes that verifies, okay, Rosa collected pay stubs, Rosa collected tax returns and bank statements. Oh, but wait a minute. There's a large deposit here in this bank statement. We need an explanation, Rosa. Can you get that for us? I'll respond, yes. Give us a minute. Do we need to stop the file here? Or can we submit it to underwriting? A lot of the times we can submit it to the underwriter if it's an explanation, but as long as we have an answer, if we do not have an answer, we want to wait till we have those explanations ready. So the file moves over to the loan processor. The loan processor will do verification of employment, might have to run another credit report, will request tax transcripts from the IRS, will do verification of bank deposits as well. So their job is to make sure that what I collected is confirming the information that I have on the application before they submit it to the underwriter. Once she has done all of that, the file goes to the underwriter. She's the one that reviews policies and guidelines for the loan product that we're submitting you for, and she would make the decision based on, do you meet all of those guidelines? So here is not a matter of, do I qualify or do I not qualify? That's kind of a misconception that we all take. It's, do I meet the requirements of the loan product, or does Rosa have to change me to a different loan program, or does my loan officer need to see what program is available that meets my needs, which is very important. I wouldn't put someone that has a low credit score on a loan program that requires a 680 or 720 credit score. So those are things that as a loan officer, we learn, okay, there's this product, you would help my client, it gives them this benefit. There is really no, some programs have credit score requirements of 580. So depending on the loan program that we're going with, we'll go ahead and select the loan product there based on your credit. The underwriter will let us know, perfect, this is a good file. The investor, us as the lending institution, we're willing to provide this financing. We just need an updated pay stub. Or since you're using a down payment assistance program, we need the approval of that assistance. Make sure that everything clears. Make sure that we have the appraisal. So there's things that they might come back and ask us for, or hey, there's a large deposit here. I know the processor asked about it. Do you have that letter already? Please submit it in. Once we have that and it's clear, they will issue an approval letter stating we are approving this loan based on this. If anything changes, the decision may change as well. So once we are at this point, well, actually, I'm going to say from the pre-approval process to the day that we close, you want to make sure that you don't apply for credit, you don't use your credit, you don't spend your money that you have for the down payment or for the closing costs. You keep everything as it is from the moment that we do your pre-approval. because just because you were pre-approved doesn't mean we're all set and ready to go. Remember, it goes through my hands, it goes through the processor's hand, the underwriter, and there's times that if the underwriter doesn't feel comfortable with issuing the pre-approval, but it looks strong enough, she might ask for a third party, fourth party to come and get involved, which is a committee that reviews if that way that committee can say, oh, well, it looks strong enough. We'll go ahead and move forward based on our experience. We can provide financing. So it goes through all those hands. So you don't want anything to change or for someone else to say, hey, this looks different from when you got pre-approved. You have more debt. You don't have the same amount of savings or your income has dropped. Be careful with those items. Try to keep everything the same unless it's a change in income to better, to more, for more income. All right, so we get that pre-approval letter. She might just ask for something small. Once we have that approval letter, we can go ahead and move to closing. Closing is you're gonna go into escrow and sign your loan documents, and now you become a homeowner. All of that gets recorded. The funding happens here at closing. And after the property is recorded under your name, you get your keys by 5 o'clock in the afternoon, or if there's a contingency saying within 2 days of closing because the seller needs to move out, then that's whatever the contract says is where we're gonna go. But at that time, you become a homeowner, ready, you get your keys. But I know this process looks here very easy when we're talking about it. Let's move on to the next slide and let's go dig into more information and dig deeper on this. All right, so the difference between a pre-qualification and a pre-approval, there is a difference. I have a worksheet right now open on my computer where I could take someone's information. They could call me and say, Rosa, I'm looking to buy a house. This is what my budget looks like. I make $80,000 a year. I have a $300 car payment, student loan of this much. Can you run some numbers for me? My question would be, how long have you been at your job? And do you have any student loans? What are those monthly payments? Let me run this scenario. What's your credit score? And I start thinking about loan programs that we can use for this individual. But I haven't received any documentation at this point. All I'm doing is reviewing what they're verbally given to me. It's very different. I cannot issue a pre-approval. I could issue a pre-qualification letter, but it's just a document saying I have verbally reviewed your information and here's the amount that you may be able to qualify for. I need the rest of these documents. I need to detail what documents we need. Compared to a pre-approval, next slide. The pre-approval letter requires for you to provide me with all your documentation. I will run the credit report. I input all your information into our system and issue what's called a DU approval, a desktop underwriting approval, which says, based on the information that Rosa has inputted in the system, verify the credit report, the debts, and the income based on the documents that this individual provided. We are happy to issue that DU approval. Anything changes, also the pre-approval will change. So difference, verbal information, pre-approval, I have to see other documents to submit it in the system. When you have a pre-approval letter, it's much better than you going out with a prequel or not knowing really how much you qualify for. Why is it important to have that pre-approval? When you're looking at properties, the listing agent doesn't want you to submit an offer if you don't have that pre-approval, because let's say you're thinking, okay, I qualify for this $650,000 home, but you don't have a pre-approval yet. It's a pre-qualification. Then something comes up on your credit report. There may be a debt that you forgot that you hadn't paid. We have to calculate that as part of the debts as well. And that can drop your purchase power. And now you feel uncomfortable because you're in love with that house and I want it. And guess what? Credit score, the debt ratios are not working because there's too much debt. Now you have to start all over. You have to pull your offer, and your realtor does not want to go out and show you a property unless they could see what your budget is like, because that way you're presenting offers that are solid with a pre-approval, with the credit score and proof of funds that you have some money towards this transaction. Next. What's considered on providing you that pre-approval? It's the 4 C's of lending: credit, capacity, capital, and collateral. Let's talk about those items. Credit, we want to know if you pay all your bills on time and how regularly do you pay them, that you're not behind. It's not just about the credit score. Some people tell me, oh, well, I have a 620 credit score. Yes, it's great that you have a 620 credit score, but we see that there's a negative account here. There's some history on your credit report that's negative. And I've seen people with 700 credit scores and still have a collection that's pending, that's old, but it's still there. So it's very important to see what's there. Remember, when you sign those credit cards, when you sign on that account, the very tiny letters right there that you need one of those big magnifying glass from the observatory park, you need to, it states that you're gonna pay that account to them or any of these assignees to the account. So that means even though I'm Macy's and you decided not to pay the account, I sold the account to a collection agency and that collection agency sells it to somebody else, that writing at the bottom still makes you responsible. It could be 7 years from the date that that account went bad, but it's still your debt because at the bottom you said you're responsible for it, no matter who's the new assignee on the account. So people say it's gonna fall off my credit report. Yes, but that's why they sell it, because we don't understand. It can come off, but it's still your debt. So we wanna see, do you have any collections, any public records on the credit report, and have you taken care of them? Sometimes you may need to take care of it at escrow and pay that account at that time, which means if it's an account that's small, we want you to pay it at escrow. If it's an account that's large, you may need to make some type of arrangement, and we have to count that as part of your debt. We're gonna wanna see current debts. Do you have credit card accounts? Do you have installment accounts, card payment, personal loans, student loans, and what are those payments? If you have any other monthly payments as well, child support, alimony, those are debts that we can see on the credit report or on your pay stubs as well, and they have to be counted as part of your debt. Other thing that we're gonna see is the capacity, your ability to be able to pay this mortgage based on the current income that you have and the income history that you've had for the past 2 years. A lot of people tell me, well, I change jobs every 6 months, every 8 months, because I want to make more money. Okay, great thing if it's because you want to make more money, but if you have any gaps that's over 6 months, that's an issue that the bank will have or the lending institution will have and may question your ability to keep a job to pay this mortgage. Your capacity is also based on your amount that you owe, because the more debt that you have, the less money you have available to pay the mortgage, because the bank counts a percentage of your income to pay the debts that you have. We cannot exceed that. And we'll talk about that debt to income ratio numbers. Next. Capital. The bank needs to see that you have some money invested into the transaction. So you need to have some money either in a savings account, checking account, retirement account, or some sort of account where we can prove where that money is coming from for your down payment, the loan fees, the closing costs, escrow impounds, which those are your property taxes, and your home insurance. Some banks may require for you to have reserves. Lately, the down payment assistance programs want to see that you have at least 1 month of reserves of your monthly payment, which includes your principal, interest, taxes, and insurance. We want to see also if you have money for moving expenses. That could be cheap as well if you invite some friends to come and help you move your stuff, but you might need to put a deposit for your light. You may have to put a deposit for gas or water. Remember, now as a new homeowner, you're responsible for all the bills: light, water, gas, and trash. Let's not forget the trash. In some places, you have a different company that collects your trash and you get a separate bill. Not like the city of LA that they include everything. You get a fourth bill for that trash. So don't be like Rosa 3 months into the house and she forgot to pay that bill because she wasn't aware Rosa had a bill. I was like, why is my trash can still full? What happened? My neighbor said, oh, they skipped yours. What happened? Like, call the company. I'm like, isn't it with my light bill? They said, no, here's the number, call them. And sure, Rosa had not paid 3 months worth of trash pickup. That's why they didn't pick up my trash, but they were nice enough to just come back around after I paid. Yay! All right. Collateral. We want to see how much is the property's worth. So if you're buying a house that's worth $550,000, the bank will go ahead and send an appraisal and confirm that the property is actually worth that amount. Very important. The bank will not lend on a property that is less than what the sales price is, unless you, the buyer, is willing to bring in the difference on the property. So let's say the appraisal comes back at, you're trying to buy a house for $600,000, but the appraisal comes back at $580,000. That $20,000 difference, you would have to come in plus your original 3% down. So $20,000 plus your 3% that you were going to put down on the property. So 3% of $6,000, we're looking at $12,000 for your down payment. So that's the money that you would be putting into the transaction. 18, I'm sorry.
Next.
Yes, 18. Condition, the condition of the property is also important. It's okay, you don't have to go back. Condition of the property is also important because the bank wants to make sure that the property is in a moving condition. It doesn't have to be fairly remodeled or torn down from the ground, from the roof down to make new, but it has to be in a condition where it's ready for you to move in if you wanted to move in the next day after you close. So the property has to be in a good livable condition. Next. Okay. Determining qualification. The things that impact the qualification will be your credit score. Remember what I mentioned, there are different programs available that are based on credit score. Some banks have, if you have a 660 or higher credit score, you may be able to obtain a 3% down loan program with no mortgage insurance. All right, so that's a benefit there. FHA has 580 credit score. If you have very little credit or no debt, you can get that FHA loan, but you're gonna have mortgage insurance, and that mortgage insurance does not go away until it never goes away until you refinance from the property. So things that you want to consider based on, let me improve my credit so I could get the better loan program possible. Loan to value means the amount of loan that you're obtaining compared to the value. That determines if you're doing 3% down, which means you would be getting a 97% financing loan. If you do put in 5% down, you're doing 95%. There's a lot of down payment assistance program that can help you with the loan to value, which means if they offer up to $161,000, that's more than 20% of the purchase price. That means you can avoid that mortgage insurance. And getting a better rate as well, because altogether helps. The income, definitely we want to see the stability of the income. The debt ratios, I mentioned that number, that term earlier. The debt ratio is the percentage of income that we're using to go ahead and pay the debt. It's very important to know that we're going to go ahead and use your income based on the gross for your qualification. And unless you're self-employed, you're taking a net home. So you have to be very careful, even though I'm telling you, based on your $6,000 home, if I'm using 50% of your income, I'm using 50% of your gross. And if you have medical insurance, taxes, retirement, account deductions, and child support, we have to consider those numbers as to make sure that you're going to have enough money at the end of the month to pay your mortgage. Because remember, those are deductions that you get before your take home. So very important to look at that. Employment history, again, that 2-year history is very important. Some banks will take 1 year, or if you're on leave, on disability, we won't count that difference, but we have to see the reason why there was that gap on there. Next. The so-called debt to income ratio, I mentioned this term twice, determining your qualification. This is the one that really tells us, not just the credit score, but this is the one that tells us how much you qualify for. The credit score tells us what program. The debt to income ratio tells us how much you're going to qualify for. So this number measures the percentage of income needed to pay all of your debts. There's 2 ratios. There's a housing ratio and there's also the debt to income ratio. Very important to know. The housing ratio is just a projected monthly mortgage payment that you're going to be paying. So we're calculating a home, let's say of 600,000, and your payment's going to be 3,500, and you're making $70,000 a year. We have to calculate to make sure that we're not using more than 45% of your income or up to 50%. Isabel, can you give me 1 second? I have to take this quick call from my boss. We were waiting on something.
Well, sure, no problem. You want, can I continue?
Sure.
Okay.
Thank you.
Great.
Sorry.
No problem. The front end ratio is about your gross income. So we go up to 45%. So let me look at my calculator. If you make, let's say you make $6,000 a month. There's my calculator. So and we can only go up to 45%. So your payment would be $2,700, more or less, based on your gross income. Now we look at your gross income and your debt. And so if you have $6,000 a month gross income and you have a car payment that you still have to pay for another, let's say 2 or 3 years, the payment is $400 a month. So we subtract 400 from 6,000. So now your gross payment is 5,600. And in order to figure out your mortgage payment, we go through either 45%, which would be, your payment would be $2,520. So it's a little higher. Or we would go up to 50,000 depending on the program and the interest. So let me go over there, 6,000 minus 400 for the car payment. And that would be 50%. So your payment would be 2,800, okay? So this is how we kind of figure out how much of a mortgage payment you're gonna have. So that's why we're always talking about, make sure you have, good credit history, good score, and a lot of debt, okay? You really wanna prepare yourself. I'm not telling you to close your credit cards, but look at the balances and see if you can keep them low, because that will help you a lot. And you have more than 4 credit cards. Yeah, I would say close 1, because you're going to be paying a mortgage payment. So you need that extra money. All right. So let's look at employment and income history. So most lenders like to see at least 2 years in the same field. They want to see some kind of history, some security that, you have a good job. You've been there 2 years and the company's strong, so you're going to be there for a while. That helps a lot, because then we know you're going to be able to make your mortgage payments yearly. Now, let's say that you're in an industry of of a job. Let's say you're a teacher. You've had 2 years, 3 years of teaching at your local school, and then you find, let's say you're at elementary school, now you go to a high school or a college prep school, and they hire you to be a teacher because you've had all this experience in education. So you can use the time that you were 2 years or 3 years at the regular school and now you're at the high school, you're in the same industry. And so you will be able to use the year in the high school and the 2 years you had that, because you've had some enough time and history in the same industry, and they're both paying you on time. So that's what we look at. If you have a small business, we do want to see 3 years of tax returns of your profit and loss statement, and that's part of your income. And then how strong is your business? Most programs require proof of income, such as paycheck stubs and tax returns. Self-employed individuals need to show profit and loss statements 2 to 3 years, which is really good. If you have your own business, it's going well, you're working hard, you just need to, provide a few more statements than usual if you were an employee, to show that you have the strength and the strong, and it's growing, and it's going to grow for a while, a long while. Loan to value ratio. The bank, the lending companies like to see the loan to value ratio around 80% to 96.5%. The percentage of your loan amount compared to the purchase price is house value. Most mortgage products have a maximum loan to value ratio requirement of 80% or 96.5. So to give you this example, everybody makes fun of me because I keep this slide that shows a purchase price of 100,000, and everybody laughs because this is something from 20 years ago. But I like it because it's a simple example. So if you're buying a house, you're looking at the house, you see the house you want, and it has a purchase price of 100,000. Then you make an offer. You go to the lender and you ask for 80,000 because you're going to put a down payment of 20,000. So 20,000 from 100,000 is 1,000. So you're asking for an $80,000 loan. What they find out after the appraiser goes and reviews the house and to other houses that are being sold around the 6-mile radius of that house you want, and shows that the house has a bigger value. It's 110,000. So if you're buying that and it goes through, you get the loan for 80,000, you put your $20,000 down, and you get the house, and you actually gain 10,000 of equity just moving in there, because the house price is 100,000. You put in 80,000, so that's 80% loan to value. I hope I didn't confuse you. So 80,000 is the loan that you got because you put 20,000 down. The 100,000 is the price. So the loan to value, it's 80,000. So no, purchase price is used in this calculation because it's lower than the appraised value, just so not to confuse you too much. But when you have these kinds of ratios, it's pretty good, strong sale. So we're talking about credit scores. I don't know if you've heard of FHA, Federal Housing Administration. They started way back when there was the recession in 1930s. And the government created a federal FHA, Federal Home Administration, to help folks buy homes during the recession. And, you know, it started closing and they started going back to work. And so they were able to get help to buy a home. It's still active. It's just that we call it an FHA loan. And here, the minimum score that they require is 580. However, most banks will not give you a loan with 580 because of the risk. So they say at the lowest they can offer is 620 score in order to give you an FHA loan. And they
Right.
will help you get the loan, but you do have to understand they do add a mortgage insurance fee with the regular monthly mortgage payment that they um, give you once you get approved. So that's why we want to help you get a bigger score, a higher score, so you can qualify for the conventional loans of the bankers. And that way you can get a loan without the mortgage insurance or not as high. The maximum score is 300 to 850. And you can reach 850 with just 3 credit cards being paid on time. I can show you. Okay.
Yeah, she's an
Bye.
expert on credit, and she will tell you, do not get any debt, do not spend your money on things that you don't need. And I will tell you, freeze the credit cards, put them in the freezer.
Yeah, that really works. So let me take it, let me give it back to Rosa, and I'm gonna change the page, okay?
Thank you. We're working on a file with my boss. The client has multiple programs. We're using our first mortgage, the city assistance, the Cal Home, $35,000 assistance, and $10,000 from another program. So she's very happy that she's getting all these funds, and we're almost there. We were waiting for our last documentation today, and it came through so that she could sign tomorrow.
Yay.
Yes, so
That's a lot
let's
of money.
it's a
Wow.
lot of money. She's getting almost 300,000 total in assistance. Yep, it can be done. It's just a lot of work, guys. A lot of work. All
And it's
right,
worth
so
it.
let's talk about the affordability, that so-called debt to income ratio, and the percentage that we use to be able to determine your qualification amount. So remember, I talked about the bank allows for us to use up to 50% of your gross income. So if you tell me, Rosa, I make $70,000 a year, and monthly, that would be $5,833. So that's the money that we use to determine how much you qualify for. So we take that amount and multiply that times 45%. And we're able to use or make a payment of $2,624.99. That's what your principal, interest, taxes, and insurance payment would include. Okay, so that PITI that you see here means that principal, interest, taxes, and insurance. Now, some programs will allow us to go up to 50% total, including whatever monthly debts you have. So in this example that we're doing here, we're saying based on 70,000 a year, this individual makes 5,836 times 45, 2,624 is what we can use towards the monthly mortgage payment. But if you have a car payment, okay, of $300 minimum, right? Minimum amount, which lately I have been seeing $800 car payments, $1,000 car payments. 630, and I just grabbed my head and I'm like, oh my God, I can't. I better save extra money to buy my next car. But that it's up into the amount of a mortgage that you can have, because if you have student loans, if you have also credit card debts, even though what we're calculating for the monthly debts is the minimum amounts, so you have a Macy's card for $35 minimum payment, $40 for a Visa card, $60 for another card. So now that $300 minimum payment on the card keeps adding up, we now have 300 plus 65 plus 40 plus 35. And let's say your student loan is on deferment and you have zero payment, just for the sake of the example. All right. The new debt that you have is $440. So we have to subtract that $440 from the $2624 that we had available to pay all the debts. But because the program allows us to go to 50%, we're gonna say now 70%, 70,000 divided by 12 times 50%, we can have up to $2,916. But the monthly payment that we're calculating, 2624.99 plus $430, that's $3,054. We're over the amount. We have to get rid of some debts, so we may suggest paying down your Macy's card or paying down the one of the credit cards that you have, a Visa, and making sure that those payments, if you have less than 10 months left on the card, we don't have the calculators, add it into the debt. So you may be okay there and still keep that monthly payment. So it's very important to make sure that we see these numbers, and it's based on gross. Remember, we're talking about gross number. And by a show of hands, how many of you take gross home? Oh, sorry, let me put my hand down, because I do have deductions, I have to pay taxes, I have to pay all this other expenses, retirement, and my medical bills, right? I take less. So again, even though if I'm saying based on your income, you can qualify for this $1 million home, at the end of the days, can you pay it with your take home? Okay. Next, choosing a lender. You could choose a lender by one, talking to Isabel, who's an expert, has all the banks at her hand on a speed dial for all of us. I have a borrower who's interested in buying. What can you do for them? Here's their information. Can you talk to them about the loan programs? She knows different programs and she could let you know. Here's some multiple lenders that you could choose from. Referrals from family and friends. You could go to your bank, your lending institution, go directly to them and find out what programs they have available. What can they do for you? Always ask the question, do you work with down payment assistance program? What programs are available that you can assist me with? Because there's a lot of them and not all the loan officers work with those programs. Find out the difference between a lender and a broker. So a lender is myself, the banks that have direct financing options. Brokers are individuals who will take your loan application and present it to different banks to see what loan product they could provide you with. They may charge a fee as a broker there as well. So there'll be higher fees on there because it'll be their fees plus the bank's application fee or the lending institution application fees as well. HUD, you could always go to the HUD website as well to see what lenders are available to help you find what products are there. Next. What are we going to need to submit this application? I've mentioned a couple of these items already earlier when we were talking about the pre-approval process. We're going to need pay stub. We're going to need 2 to 3 most recent pay stubs. If we're going to need to calculate your overtime or bonus and commissions, we also want to see the last 2 years last pay stub for the year, because that's going to tell us the year-to-date numbers. Maybe you had a lot of overtime in December or in April or in the summertime. They give you more hours because people go on vacation. We want to see what's the overtime average for the past 2 years, and we're going to be able to calculate that average for the next year as well. If you receive any type of assistance, Social Security, disability assistance, we want to see the award letter, the most recent, showing how much is that amount. So that if you plan on using that as part of your income to qualify for the loan. Social Security card and picture ID. We need to verify you as the individual. We need to see sources of your down payment. If you're using the money from your savings account, checking accounts, or a 401k, we want to see that. If you're going to receive gift funds from family members, they need to send you the gift letter stating that these funds are free. We can give you a sample of the letter for them to fill out. They need to sign it. You need to sign, and it has to state that there is no repayment added to that gift that they're providing. We're going to need the last 2 years tax returns signed and dated, W-2s for the last 2 years. We need the bank statements, 2 to 3 months of most recent bank statements, and the last financial statement if you have a 401b, an IRA, a CD, or any type of retirement account. We need to see the last financial statement. Some of those show up as every quarter, or some are every 6 months. So whatever you have available, we want to see and verify if that's where you're saying you're going to use your savings. And also, it could be shown for your reserves if the program needs reserves. Next. Sources of down payment, again, could come from your savings account, retirement account, gift from family or family members. Down payment assistance programs. There are multiple down payment assistance programs that can assist you with funds. And also the seller can help you with some of the money towards your down payment. Next. What is a mortgage loan? A mortgage loan is funds that you're going to be obtaining, a loan that you're going to obtain from a bank or a lending institution to purchase a real estate property. The property is used as the collateral to confirm that you will be paying that money back. Mortgages are structured by such factors as how long you're going to have this loan for, establishes the payment and the interest rates as well. Next. The payment, what consists your payment, your monthly payment for the house payment would be principal, interest, taxes, and insurance. The principal is the amount that you owe to borrow the, the principal is the amount that you borrow from the bank to purchase this property. Interest is the cost of borrowing that money. So there's no free money from the bank. It always has an interest. The taxes will be the local taxes of the area where you're buying the property at. So City of LA, the property taxes are 1.25. Certain areas in Compton and also in Gardena, they're a little bit lower, or they can be higher depending on the services that they're providing. And that's based on utility services. Insurance is your homeowners and hazards insurance. Your property must have hazard insurance at all times. Next. There's different type of loan programs available. There's fixed rate mortgages, there's adjustable rates, there's interest only products, and there's also options and adjustable rate mortgage, which is something that for us, the consumer, for us, the first time buyer, we are not looking at. We want to see a fixed rate mortgage is what you really want to look at. Adjustable rate means it's going to change after a period of time. Interest only, you're only paying the interest. You're never touching into that original balance that you acquire. These are the other bottom loan products are programs. If you have a plan, I'm going to take an adjustable rate program or an interest only until rates change or until I get more income. Right now, it's really not something that you want to look into because rates are so high, it doesn't make a big difference. Might as well just go with the fixed rate. Next. There are different type of loans available. There's government loans we mentioned earlier. FHA offers some financing for individuals who have lower credit score. It's a government guarantee program through the Federal Housing Administration. It provides mortgages with insurance and loans made by FHA approved lenders. So not every lender provides FHA loans. They also offer the 203B loan, which helps you with adding additional construction. The 203K loan has also property improvements. And we have the energy efficient mortgage through FHA as well. Other government loans are also the VA or the CalVET. If you are a veteran or you're an active military individual, you can use the VA loan program. Conventional loans are non-FHA loans. These are loans that are provided directly by a bank that uses Fannie Mae and Freddie Mac guidelines. They have restrictions and they have their own guidelines. So compared to what we mentioned earlier, FHA could do a 580 credit score. And we all say, yes, Mr. Government, we're going to try to do that. But the risk is on us, on the lender itself. We try to be a little bit more lenient. We like, well, go ahead and provide some financing, but we want someone who's a little bit more strong. So how about a 620? Okay, that sounds good. Okay, we're compromising. That's how the program works, because at the end of the day, the government only guarantees up to 80% of the loan amount that we're doing. The rest we have to scrap around and see how we're going to get repaid, right? So we want to make sure that it's paid accordingly, because if not, we would be in bad position, and no bank wants to be in a bad position or losses. So the conventional loans follow more strict guidelines, but they have made it so much improvement since 2008 by being able to provide first-time home buyer programs with no mortgage insurance, lower credit scores like a 640. And I feel that that's very fair to provide someone a 640, because it might be not that you have bad credit, it's just that you don't have enough credit history. But look, I'm improving, I'm doing good with what I have, I can manage this. And my goal is to buy a house, so give me a home loan. There's also CalFHA, California state program that offers a 3% down program. They offer their own programs as well. They just had the big alert of the California Dream for All product that gives you up to 20% of the purchase price, or $150,000. It's a lottery that they're having. Everyone has been submitted. The cutoff deadline was April 29th. We were pulling our hairs, doing loans and running numbers in our sleep. We did a Friday, Saturday, Sunday, Monday deal. We were there till late at night the first 3 days. And on the last day, still at 4:50, we were getting calls. Can you run my pre-approval? Like, baby, it's gonna take me more than 15 minutes to run some numbers. So I can't, I'm so sorry, because we had to do a full pre-approval in order for them to get enrolled. So there's programs available, there's multiple assistance. There's the USDA Rural Housing Program as well, that their cost is a little bit lower. And it helps if you're looking to buy a house in a more distant areas, which is what a lot of people are doing. Property values are high in city of LA, county of LA. So they're saying, I still want a house. So where can I find something? And if you get pre-approved for something and you find a house, hey, go for it. That's what I tell people. It's the most important thing of going through this process is making sure you get to your goal, buying a house. Next, terms of different types of loans, there's 15-year loans, there's 30-year loans. Us as consumers, we want to get a 30-year loan. Yes, a 15-year loan may give you a lower rate, but your payment's going to be much higher. And usually when we need the help is when we first buy a house. As we get into the loan, we're going to be able to put more money. So honestly, you could pay down your home loan in about 3 years less if you just add one payment to every year or a payment and a half every year, you could finish paying your mortgage in less than 30 years. So look and see what best benefits you at the time that you're qualifying. And that's why there's so many down payment assistance programs to help you to keep that monthly payment affordable to you. And when do you want to buy a house? When you qualify and when you feel comfortable with it. It's not when the rate is the lowest, when the prices are the lowest. No, it's when you're ready, when you're able to afford this house. Next.
Technical difficulties.
You want to talk about points or just end it?
We can talk about points really quick, especially right now with rates being so high. Let's talk about points really quick. I'll be very quick.
Okay.
You have a slide for it or just go off the top of my head?
Oh, you don't see it?
Uh-uh.
Oh, okay. What happened?
It's frozen, I think. At least on our end, it still shows the 15.
Let's try-
Bye.
I either had too much sugar today, ladies, but I feel like my heart is beating.
I love the
Woo!
energy.
I had so much water, but oh, okay, there we go. What are points? Points are cash payments made to the lender at closing to help you lower your rate or to obtain this loan at the time. With interest rates being so high at the moment, we can tell you, okay, rate is 7%. Okay, that's where rates were today. So my client really got a good deal at being able to close him lock him in at 6.875. Rates have been as high as 7.875, guys, this past month. And we did some pre-approvals and we told people, here's your pre-approval, but this is the amount just because the rate is that. And they would tell us, well, how can I get it lower? You would have to pay some points, which means 1 point could get you as low as 1% of the loan amount. So it's not by paying 1 point, I'm going 1% down. 1 point could be 0.75, 0.125. It depends on where the rates are. That's how you're going to be paying. So let's say we started at 7% interest, but you want to go as low as 6.5%. So we have to go from 7.8 to 6.925, 6.875, 6.625, and then we get to 6.5. So all those three numbers that we have to go down, 6.925, 6.875, 6.625, those are 4 rates that we have to drop. So that could cost you either 1% or 1.5%. Most loans or most lenders will allow us to buy it down at 2 points. Sometimes because depending on the market, they may say, okay, we'll allow 2.5. So that means that if you're buying a house for $150,000 and you have to pay 1 point in order to get to 6.5%, you're going to pay $1,500. So when we talk about the points with you, we will let you know based on your loan numbers. There's this is how low we can go, and this is how much it will cost you. Remember, that's on top of the closing cost fees and the loan application. So you're going to need to determine, does it make sense for me to buy down my rate? Does it make an impact on my monthly payment? So it's not just I want to buy it down. It's like, how much does it drop my payment to? Should I put that money and invest it? Or should I sit tight on that 7% interest and wait until I can refinance? Remember, it's not just interest rate right now, it's interest rate times month, times the months that you're gonna have that loan for. And if it makes a difference is, okay, it makes sense. So how much does it drop my monthly payment? How much I'm gonna save over a 30-year period? Or I know I'm gonna be able to refinance in 5 years when rates drop, or in 6 months, when are they gonna drop? Where's my BB gun? Gotta drop those, gotta shoot them down, right? I know I ate clams today, you guys. Next time I'll bring some balloons, some confetti, a rabbit jumping. Oh, I do have a rabbit that can jump out. I'll make sure to bring him over. But those are things that you have to consider with the interest rate. How is that going to impact me long-term and short-term? If it's a short-term solution while interest rates drop, great. But if it's a long-term that you're looking, you might want to wait till rates really drop, because every time you refinance, you're also having to pay closing cost fees. Some banks may pay for those closing costs, may give you a credit, but that's money that you're going to be adding into the loan. So does it really impact your payment, or should we wait? So those are things that you have to talk about once you're there as well. All right. Was that
Great.
clear?
Right. That was
Good job.
great. Thank you, Rosa. Thank you
You're
so much.
welcome.
All
I'm
right.
gonna go get my
So
bunny
then,
before you guys shut down. Oh no, he won't let me grab him that fast. Next time I'll bring him, okay?
all right,
Guys,
sounds good.
Brenda and Renee, we want to see you at the next workshop when I have the bunny.
All right. Okay, well, thank you everybody for joining us, and I guess we'll see you guys next Tuesday at 6 p.m. for the next session of Operation Hope's First Time Homebuyer Series. So thank you
Awesome.
again, Rosa. Thank you so much for your time. Thank you, Isabel, as always, and thank you everybody who was here. All right, you
Awesome.
guys.
Thank
We'll
you,
catch you guys
ladies.
next
Have a
time.
good night. Goodbye.
All right.
Okay,
Bye.
thank you.
Bye.